Good afternoon, everyone. This is Kim Schmidt, Executive Editor of Farm Equipment Magazine. Welcome to our latest webinar in conjunction with the Western Equipment Dealers Association and Iron Solutions. Today we'll be discussing used equipment trends and a forecast looking to the year ahead. Today's presenters are Cameron Hernard, Director of Data Services and Software Development for Iron Solutions, and Amanda Patrick, Director of Sales and Business Development. Iron Solutions is a data aggregation and analytics company that's been providing equipment valuation data to the agriculture industry for over 30 years. Before they get started with their presentation, I just had a couple of housekeeping items. On your screen, there's a control panel with a Q&A icon. You can submit questions at any time during the presentation, and Cameron will be answering those as you submit them. And then if for any reason you lose your internet connection and it looks like the webinar has been interrupted, just go back to your email that told you how to get into the webinar, and you can re-enter that way. Okay, we are ready to get started. Thanks again for joining us. Take it away, Cameron.
All right. It's actually going to be Amanda that's going to kick this off. So good afternoon, everybody. I'm Amanda Patrick, Director of Sales and Business Development here at Iron Solutions. We've been providing equipment valuations in the industry for over 80 years. We do have a 30-year historical database, and that's what we're digging into today when we go back and talk about trends. So I do want to thank our sponsor for this webinar, WEDA. They have a great conference coming up called the North American Dealer Conference. It's next week. Myself and our GM, Linda Radar, will be there. We're happy to have some discussions with you guys if anybody's going to be there with us. So thank you again, WEDA. Before we get going, I do want to make sure we define some of the data that we're going to talk about. That'll help you interpret some of the trends we're talking about and help you understand what might be driving some of those trends. So we're going to pull from two main sources. The first one is called Iron Monthly. And this is a monthly trend that we monitor, and it's using used equipment values. So these are the transactions being reported to us from dealers on the retail level. It's using a rolling 12 months of normalized used equipment transactions with the age range being 1 to 5-year-old machines. We use 1 to 5-year-olds because we don't want the older machine transactions coming in every once in a while and changing that trend line too much. So the 1 to 5-year-olds gives us a really good insight into what's happening in the used equipment market. The second piece of data we're going to pull from is called the Iron Index. This is a quarterly used equipment depreciation trend. So it's measuring the depreciation of used equipment from the new selling price. That data source is directly from the Iron Guides product using the resale cash value. This is tracking 1 to 3-year-old machines. The reason we're looking at 1 to 3-year-olds is we're trying to look at that first turn of equipment. So when we're talking about normalized transactions, let's dig into what that actually means. So when you define normalization, it's adjusting the values measured on different scales to a nationally common scale. So a lot of times when we get sold transactions in, the hours are different, the options are different, configurations are different, condition might be different. So we're able to go through and adjust those sold transactions so that we're comparing apples to apples. So if one machine had a loader and another didn't, we know the value of that loader, we're able to remove that value so that we're looking at an apples to apples comparison. So that's what it means when we say we're normalizing transactions. I'm going to go ahead and hand this over to Cameron to go into some deeper dive into the trends. If you guys have questions, please feel free to use that Q&A box. I'll monitor the chat box as well, and we'll answer those as we go. Go ahead, Cameron.
Thank you, Amanda. So this afternoon, we're going to spend a little bit of time. We'll talk about some trends we're seeing in the market. We're going to talk about where we are now, where we've been in the past, and a look at where we may be going in the future. So I'm going to start to spend most of our time today talking about the Iron Index. Amanda gave you the overview of how we calculate the Iron Index. But the first thing I want to do is give us a point of reference on what the Iron Index would look like in a perfect equipment market world. And that perfect equipment market would be a place where we have balance between the supply of new equipment, the supply of used equipment, and demand for new equipment would match the demand for used. Now, of course, this is an overly simplistic way of looking at it, but it gives us a good point of reference to what we're going to be talking about today. So on the screen, you see a flat line that represents a depreciation of, somewhere around 26%, or the difference between the new selling price and the used selling price, and it just stays the same because as the new prices go up based on inflation, the used prices are going to go up by the same percentage, and really what we're measuring is the difference between the two, and it just stays the same. So what we see, though, regularly is this balance, or the market gets out of balance, and then in that case, the index goes up or down. So let's take a look at the index and see where we are now. So we're going to look at the fall index values, and what we have on the screen is our overall index for ag equipment. Let's talk about the indexes a little bit more. We create an index value for each model in our guide, and then we roll up all the models into a class to create an index for that class. So think of a class being four-wheel drive tractors, for example. So once we've got the class index set for all the classes under tractors, we then roll up those values to create a type index. And then once we've got all the type indexes, we roll that up to create an overall index, which is what you're seeing here. Now, overall, our fall values for the index are up as we look year over year. And this is the first time we've seen this happen since 2013. So if you look back at 2013, our index was about an 81 and a half, roughly. And then we saw a significant downtrend on that right through the fall of 2018. But now we've seen 3 consecutive quarters of year-over-year improvement in the overall index. Now, the index can improve on 2 things can happen. Since we're measuring the difference between the new price and the used price, what they get on trade-in, and we're measuring that gap, if the new price stays the same and the used prices increase, we're going to see that gap narrow and our index increases, or what we consider improves. Now, the other thing that can happen is new prices can go up and used prices stay the same. In that case, our gap will widen in the index and the index goes down. So keep those in mind as we go through this afternoon and talk about these values. And we'll tell you that what we're seeing over the last 3 quarters is that the index is improving on the basis of used prices improving. So new prices are staying not the same. Manufacturers are still taking their new price increases, but what we're seeing is that those price increases are not as significant as they have been in the past. We've cleared out a bit of a glut of used equipment, and now the used prices are improving. So what is driving these last 3 quarters of improvement in our iron index is the used prices improving. And we're going to see a bit of that later when we look at the monthly values. Because we're looking at an overall index here, we have to think about what segments are helping out the index. What we're seeing here is the index being up on strong prices in the larger tractor segment. Think the high horsepower units over 180 horsepower and the 4-wheel drive tractors. Our combine index is also up year over year. If we look at the last 2 quarters, it couldn't keep that going in the fall. We did see used prices backing off again in the fall, dropped down about 0.4 from the fall of 2018. So what we have really is the index being up on the large tractor segment. So what we'll look at here now is some of the individual types. These charts talk about the class 6 to 8 combines. We can break these out in any number of ways, but for this I thought it best we look at some of the common classes in the mid-range 6, 7, and 8 combines. We're seeing the trend downward here. The chart on the left has our iron index in the blue and a 12-month moving average, which you can see for the last 3 quarters is showing some signs of improvement. The iron index line shows these peaks occurring in the winter. And I just want to talk about those briefly, because the iron index is calculated quarterly in conjunction with the release of the official guide. And so this is why you see those spikes. That's what happens when we release the new model year, and then the depreciation starts again a quarter at a time. So you'll see these pick up in the winter. It's important to look at these as year-over-year comparisons to make sure we're getting an apples-to-apples comparison. That's what the chart on the right will show you, the comparison for each of the quarters. And we can see the 2019 values are up year-over-year back in the spring and summer. Fall was close. We couldn't keep that strength going on the combine index. So other thing I want to talk about, just mention this, is the U.S. Index. We calculate values for both U.S. and Canada. So let's take a minute. We'll look at the Canadian index here. The Canadian index has a much different shape to it, and this is really due to the impact of the exchange rate and the Canadian dollar. The significant changes in the Canadian dollar lead to changes in demand, particularly when we have periods when the Canadian dollar is worth significantly less than the U.S. dollar. Assuming all other things are equal, then due to the exchange rate savings that really offset some shipping charges. So what we see is demand increases in Canada when the Canadian dollar is low. People in the border areas, northern United States, can go into Canada, purchase equipment, and ship it back, save themselves some money. So we see the impact of that in the index. However, the last couple of quarters, that Canadian index has also been strong and had a similar drop-off towards or into the fall, maybe related to some conditions, and we'll talk about that when we get into the forecast segment here a little bit. So now, what I want to talk about is a breakdown of the iron index, and Amanda mentioned that the index is the comparison of the new and the used. And here, these charts will show us exactly what that impact is. And here we're looking at the average used selling price, of used combines. And in a normal balanced market, these lines would be parallel and up and to the right. So what that means is that the used price was increasing at the same rate as the price for the new units. However, if we look at these charts, we simply see that is not the case. And what we see here with the combines, that the gap between new and used prices has been widening. Now, Class 6 combines up in the top left, we see that starting to change now. And that is why we're seeing some improvements in the index. If we look over at the 3-year-old combines to the top right chart, that gap is continuing to widen. So this tells us that while manufacturers are continuing to take price increases, the used prices are not keeping up, and our costs are widening. Our gap is widening. So this means to the farmer that it's costing him more capital for his equipment, paying more for it, getting it less when he trades it in. Now the bottom set of charts just show the same thing for Class 7 combines. A little bigger, a little higher horsepower equipment has the same issue, but particularly 3-year-olds, we're really seeing that gap widening, so getting quite expensive for farmers to use those Class 7 combines. Here's our first chance to look at a monthly value. Amanda talked to you about the monthly trend. Just to reiterate on that, this is the averaged used selling price of an average combine. I hate saying average so many times, and people that know me know I'm not a big fan of averages, but what we do here is look at the common equipment that is selling and determine what the age of that equipment is, and then we adjust these retail transactions for normal hours and for seasonality, and then just measure what the actual selling price is of that unit. So we can look at these lines here. The red lines on the chart are the actual selling price adjusted for normal hours, and the dotted line is the average age of that equipment. Now, keep in mind, when we lump this data together and we do the analysis of it, we're only including here combines that are 1 to 5 years old. Amanda mentioned we don't want to have these older units messing with the data, so this gives us a very good data set to measure and look at the trends. So a couple of things can happen here as we're watching the price go up. Think about the age of the equipment. If the age of the equipment goes up, means that the average unit being sold is older, we would expect to see that average value drop off a little bit. So important to pay attention to the average age line. If that age is coming down, we'd expect to see the price go up. So that's why we've included on these charts, just to make sure that you can understand if there's a relationship between age in the data. Over on the right-hand side, we look at Class 7 combines, and I chose to talk about Class 7 combines today because we can break this out into 3 periods over the last 10, 12 years and talk about that briefly. So let's take a look here. If we look back between it was about 2005 through 2010, we see that that's really a period of rapid price increases. So think about what's going on back in that time frame, and it probably makes sense. The demand for used equipment and new equipment, for that matter, was going up, and the prices were tracking up. Now, over that period, if you look at the age line, it's staying pretty stable. The age, not much variance off of about 31 or 32 months of age. After 2010 through till about the end of 2013, I see this as more of a period of normal price changes. So the slope of that line changed, and we've had a period of 3 or 4 years of normal price. But we also see the age of the equipment starting to creep up a little bit. We get up around almost to the 3-year-old equipment being the average sold towards the end of 2013. Now, our last segment is a period where we've had some pretty significant volatility. Think what's happened in the markets from 2013 to now. We've even, we've seen some price decreases here. So what's happened? Commodities have fallen off pretty significantly during that time period. The volume of used equipment sitting on the dealer lots has gone up. So what we see with that is a corresponding leveling of the prices, and even a period where the prices have fallen off. Look back around the beginning of 17, the end of 16, early part of 2017, prices dropped off. They've leveled off through last year, but now we see some hope at the, maybe a light at the end of the tunnel here as prices are starting to trend upwards a little bit through 19 here. Now also we're seeing the age of the equipment come down a little bit. It had got up north of 40 months and now that age has dropped back down around 37, 36 months age for the average piece of equipment. So I think it's interesting to just talk about that, break that out a little bit and think about the periods. And as we're thinking about the future, this gives you some idea perhaps what we can expect as we relate to what was going on. So let's talk now about 100 horsepower tractors. This is all the tractors over 100 horsepower, but we exclude four-wheel drives from this one. We have those in a separate index that we'll talk about. We see now we've had 3 consecutive quarters of year-over-year improvement in the index for these high horsepower tractors. This is a very large segment when you think about grouping all of these together. Now the improvement we're seeing here, we feel is based on manufacturers starting to scale back production on the new units being produced and not increasing their MSRPs as much as they have been in previous years. So MSRPs staying a little slower increase in the MSRPs while the used prices are improving a little bit. In the past years, we've seen 5% increases in new selling price. The last little while, I'm seeing more in the 2% range for those price increases. So we think that's what's causing the improvement in the iron index. So you combine this with the improvements in the used selling prices, and really that's what's narrowing our gap between the new and used and driving our index up a little bit. If we look at the Canadian values, in Canada we had a couple quarters of improvement before a year-over-year drop again when we released the fall index. If we look at what's going on in Canada, the western part of the country, had pretty poor weather during the growing season. Some comments being that worst anybody has seen. That was compounded by delays in the harvest. So, given all that, I think the Canadian index is still doing pretty good. If you think about general economic downturns in Canada, it contribute as well. But we'll wait and see on that for next year. But looking not too bad for Canada on the high horsepower tractor segment. Let's jump in and look at the details on the used tractors. This is similar to what we talked about with the combines. The top left is 180 horsepower and above tractors, 1 year old. Once again, we talked about how the lines here should be parallel. If everything's working the way it's supposed to, we'd have parallel lines up and to the right, but we're seeing that gap had widened for quite some time and starting to come back together a little bit, particularly if I look at the used selling price on the 1 year old 180 horsepower, that's starting to tick back up a little bit, and that's where we're seeing the gap narrow in the index. 3 year olds still significantly widening there, but some signs of improvement if we look at the used price there as well. The four-wheel drive tractors, you can see new prices showing a bit of a trend down here, which is while the used is staying much the same. So we're seeing a narrowing of the gap there, which really is an improvement in the iron index. So some good things on the tractor market, particularly in the larger horsepower segment. So let's take a look at the monthly values. Similar to what we saw in the combines, I'll leave it to you guys to look and figure out where those sections are, but you can see it's similar here, those periods of, fairly quick increase, some slowing down. But if you look at the four-wheel drive tractors, back from about 14, we really started to see these level off the used price, perhaps related to the age increasing. Now that age increasing can be tied to equipment sitting on the dealer's lots for longer before it's sold. As demand dropped, there were tales of people having trades that sat a full year before they sold, so that will drive up the average age on the equipment. So that particularly, you see that around 2017, the middle of 2017, you've got the high point for the age of the equipment and the low point for the pricing. So those two may be related there, a period where demand was quite low and prices struggled. But good point, what we're seeing now over the last 6 months is a good trend upwards again. That line, it may be difficult to see on the right-hand side of four-wheel drive tractors, has just gone flat again over the last couple of months. So we'll be keeping an eye on that to see where that leads us over the winter. All right. So let's talk a little bit about where do we think we're going, and in order to get some idea on where we're going in the future, we really need to think about where we've been. And if we look back here at 2013, the index here for high horsepower tractors, 100 horsepower and above, that's where we see this index starting to drop off. When we talked earlier about 2013 being the point where all this started to go south. And back at that point, our index was just above 83. Corn prices were $7.30 a bushel. Beans were over 15 bucks, and there wasn't a lot of used equipment inventory sitting around. Things were pretty good. Now, if we look at the spring of 2018, we see the index is down to 70. Corn is down at $3.20 a bushel, and soybeans are just north of 9 bucks, and we've got a lot of inventory sitting on the lots. So that, if you look now, today, I think we're probably somewhere around $9.30 for beans and $3.80 for corn. So we're sort of in a similar range. And if you look at the index, the indexes are pretty much in a similar range as well, hanging around that 70 mark. So what's going to drive changes now? We've been in a period here where it's been flat for 6 quarters. What's going to drive any change? And if we think about just simple supply and demand changes, the producers that normally buy the used tractors, really something has to drive them to start buying more of those. People that buy new equipment may need to augment their fleets with used if we're going to see any changes in that. And that's not something we've seen in the last little while. We still see strong demand for new equipment. And really, when we think about what's driving that new demand for equipment, it is basically technology. We're in a time of very tight margins. There's not a lot of money to be made in corn or beans. So when you are putting your crop in, you've got to get as much as you can and really manage the expenses. So we see some producers moving to new equipment to take advantage of those new technologies, improve the yields, perhaps lower some fuel costs to gain whatever savings they can. Now, by doing that, we end up putting more used and fairly good quality, newer used into the market where the demand for it, may not be there. So we've got to keep an eye on that and really try and figure out if what we're seeing in the last few quarters in this upward trend is just a blip, or if this is really something significant that may continue. And really, until the fundamentals change, we don't see anything really driving that change. So the other thing that we got to keep watch out here is there's been a lot of movement towards lease. A lot of people are talking about leasing, more new equipment being leased. What the impact of that will be is as that comes off lease and we get that equipment coming back into the used inventory, that could further depress used prices if we get a significant supply of good used equipment again. So Amanda, I think we have a question.
We do. So the question is, why, with the ag economy not strong, would we see used equipment prices improving?
That's a good question. So people are picking up some of the used equipment, and it may not be as much that the used, we see on the monthly, there are some prices improvement on the bigger tractors, some demand on the big tractors, a specific segment there. Not sure what's driving that. However, could be, good question, could be a lot of things. I'm not sure what's driving that right now, but we do see that in the reports that are coming across. So it's good for the dealers, good for the producers. Good trend there. So any other questions we've got come up?
I think there's one more.
So we got somebody else asking about the used equipment, and somebody's asking, it could be people substituting used for new, and that is definitely a possibility. We could be seeing that as money gets a little tighter, that instead of buying a new unit, people are upgrading older used and going used for used instead of going used for new. So that is one possibility as well. If that's the case, we could see demand going up for the used a bit and improving the prices. So.
Hey, Cameron, I have a question for you. So
okay.
Going into 2019, there was a lot of talk about how we are for real in a replacement demand type of cycle now, and people are going to be buying equipment because they haven't for so long, and it has to get replaced now. And then 2019 went how 2019 went with weather and trade and all of that. And so some of that replacement buying didn't really happen like we thought it was going to. Do you have any indication of if that, can we expect that now in 2020? Is it, whom the heck knows? Any thought there?
Well, that's, it's a very good question. Who the heck knows is probably a valid answer as well. But we have to look at what manufacturers are doing, and the manufacturers are starting to reduce the volume of new coming out. So they are feeling the impact of that replacement not happening. But I just talked a little bit about the technology. People are going to have to move to it. So I would say this is going to, possibly just postpone it a little bit. If we look back a few years, 15, 16, there was a lot of buying going on, a lot of new equipment moved. And if we look at the tractor side in particular, let's just talk about tractors. They have a little more longevity than the combines do. What we end up with was a relatively young fleet out there. Everybody got rid of older tractors and all bought new tractors. So we had a lot of new stuff going out. Manufacturers were pushing new equipment very hard, and people had a little bit flush with cash, so we're buying a lot of new equipment. Now, what that did was change the makeup of the fleet a little bit of in-field tractors, and ended up with having a fleet of much newer equipment, meaning it can last longer. And when corn drops to $3, the producer doesn't have to buy a new tractor. Now, combines wear a little bit. You're dealing with tight timelines around the fall harvest. You need to get your crop off. We see producers still turning combines a little more rapidly, but we ended up with a fairly new fleet of tractors out in the field that can weather a couple years of low commodity prices or low volumes in terms of bushels to the acre, so that they didn't have to buy new ones. But so that equipment's now aging another year. They didn't buy anything this year with the slow start, so maybe we'll see some pickup in the next year. That is definitely a possibility.
Okay.
Excellent. I don't see any other questions. So to wrap this up a little bit, again, thank you, WEDA, for sponsoring this and giving us the opportunity to present this data to everybody. They do have the North American Dealer Conference next week, so we'd love to see you guys there. And should you want to reach out to us, we're happy to answer your questions. If you didn't want to ask them on the webinar, we will get back to you and answer those through email. Again, thank you, WEDA. Thank you, Farm Equipment. And I'll kick it back to you, Kim.
All right, thank you guys. For anyone who would like to rewatch the webinar, we will be making the presentation and the audio available on the Farm Equipment website. So keep an eye out on your email and the Farm Equipment eWatch newsletter for more information on when that's available. On behalf of Cameron, Manda, WEDA, Iron Solutions, and the Farm Equipment staff, thank you for joining us for today's webinar. When you leave the webinar, you'll be directed to a short survey. Please feel free to reach out to us and let us know what you thought of the live event. And if there's any topics you'd like us to cover in the future, let us know. Thanks again, everyone, and enjoy the rest of your day.